Should you invest in stocks or bonds? The benefits and drawbacks of investing in stocks versus bonds differ. Each asset type, in addition, has a radically different structure, payment, return, and risk profile. In order to establish a long-term investment strategy that succeeds, it is essential to understand the differences between these two asset groups. Investing in the long term and saving for retirement necessitates different asset allocation strategies for every investor. Stocks have the potential for bigger returns than bonds, but they also carry greater risk. Hello everyone, and welcome to another video on our channel. In today's video, we'll be discussing whether you should invest in stocks or bonds. Yeah, you heard it right, so let's start our video. We will prefer investing in stocks to bonds. Investors are given the option to take part in the expansion of a firm through the purchase of stocks, which are basically ownership holdings in publicly traded corporations. On the other hand, the value of these investments could potentially decrease, and they could even lose all of their worth entirely. In either case, the profitability of the investment is nearly entirely contingent on shifts in stock prices, which are inextricably linked to the development and financial success of the company. A bond is a financial instrument that pays a fixed interest rate and reflects a loan made by investors, often known as creditors or debt holders, to borrowers, who are typically businesses or governmental organizations. Bonds are distinguished by the fact that the borrower guarantees the ultimate payouts. These payouts are sometimes referred to as coupons. There's a predetermined maturity date associated with these investments. On that date, investors will receive a return on their initial investment. In addition to the interest payments based on the interest rate that was in effect when the loan was initially taken out, bonds can be used as a source of financing for various projects and activities by private companies, state and local governments, and even national governments. Having said that, certain bonds do present the possibility of default, which means that an investor could end up losing the money they invested in them. High-yield bonds, also known as speculative grade, non-investment grade, or junk bonds, are debt obligations with a rating lower than that of investment-grade debt. Despite this, they appeal to a segment of fixed-income investors who are drawn to the possibility of greater yields. Benefits of buying stocks over bonds. Stocks outperform bonds in terms of yield, which is their primary selling point, in exchange for the chance to profit from rising stock prices. The more risk-averse investors would be better served by investing in stocks. Additionally, dividend-paying companies may be a good investment for investors. Dividends are paid to shareholders as a portion of a company's profits are accumulated. Non-distributed profits might be reinvested in the business by purchasing additional shares. It is possible to earn interest on bonds, but this money cannot be reinvested in the original bond. Interest rates fluctuate throughout a bond's lifespan, posing a risk of underperformance if you decide to reinvest your money into new bonds. Negative effects of stocks. For the most part, stock investments have a higher degree of risk than bond investments because they don't give guaranteed returns to investors. In the event of a company's bankruptcy, bondholders, who are the company's creditors, take precedence over stockholders. On the other hand, owners of common stock are the last in line and could lose everything if the firm fails. Bonds are preferable for risk-averse investors wishing to protect their funds and benefit from more predictable payouts. Since 1928, the average annual return on equities has ranged between 8 and 10% during history. Since 1928, the average returns on bonds have ranged between 4% and 6%, making them a less lucrative investment option. While bonds have only returned an average of 5.6% per year over the previous 30 years, the average return on equities has been 11% yearly. A portfolio is considered to be well diversified when it holds a wide variety of holdings from several different asset classes. In general, the longer your time horizon, the younger you are, the more risk you can take. This is because your time horizon is greater. Therefore, it's possible to maintain a level of comfort with a portfolio that's comprised of between 80 and 90% stocks, and the remainder in bonds or other assets. However, suppose you have a shorter time horizon. In that case, it is recommended that you reduce the proportion of your allocation that is invested in stocks and increase the proportion that is invested in bonds with lower levels of risk. Due to investors' equity risk premium over bonds, stocks often beat bonds over the long term. Investors want this amount to take on the added risk of investing in stocks. A strengthening economy is also good for stocks. Corporate earnings rise in tandem with GDP, which is reflected in stock prices but not often in bond prices, which are essentially loans. Well, that's all for today's video. Tell us in the comment section how this video was. I really hope that you found this one interesting. If you want to see more videos just like this, please consider subscribing for more. And don't forget to give comments and provide us with your valuable feedback. We'll see you in the next video with some more interesting facts and stories about economics. And until then, stay tuned.